Hey guys, John here from Side Hustle Investing, and today we're going to make our first trade in our 30-day challenge between Optionshouse and Thinkorswim. And right now, when I'm making this video, implied volatility just across the board is extremely low. The election has just been passed over, and there's just not a whole lot going on for us premium sellers in options trading, but there is some decent volatility in TLT. So I'm in my Options House platform right now, and you can see the volatility graph is still quite high, and it's showing in the 60th rank in implied volatility range. We'll cover that concept a little bit later. So right now, if I look at the chart, it's gone up, it's going down. I don't particularly have a directional play on this, so we're going to go ahead and make an Iron Condor, which, if you guys are not familiar with it, you'll see the risk profile chart look like this, which basically says that between some strike prices, we're going to make some money, and outside of here, we're going to lose. But it basically gives us a nice wide range, and what we're going to do is target roughly the one standard deviation, which is the 70 percentile, or 70% probability of success within these marks. And I'll show you how to do that with the Options House platform. So the first thing I normally do is just take a look at the chart, just see if I have a bullish or bearish feel for it. And in this one, I really don't. So we'll go straight over to the options section. And I've customized mine to look like this. I want to have the probability of being in the money at expiration on right next to the bid and ask. And also, if yours aren't looking blue, just a quick little note here, this button over here, bid ask trading, I really don't know if it matters that much. I like having it blue because I know which ones are quick and clickable. But if you turn it off, they turn white. But the funny thing is, the functionality is still very much the same, which we'll walk through in just a second. So what I'm going to do, because we are in November 27th right now when I'm recording this video, the December contracts are only 20 days away. As a new options trader, I want a little bit more time to watch to see what happens to the stocks to the option over time. So we'll be trading the January contracts, which are currently 55 days away. And I have mine set to show 50 strikes. I could have it say show all strikes. It really doesn't matter that much. You do notice that there's just a little bit of slowness with this platform. It does take a little bit of time to load up and show you everything, but once it's there, it works quite well. Also, for me, I'm not a high-frequency trader. I don't get in and out of positions in the same day, and especially as a new trader, time is not really of the essence. I'm right now, I'm learning, I'm educating, so the simplicity of this platform I do see as being a big benefit. So as I scroll down and I'm looking through these different strike prices, what my eye is scrolling on is on this column here. I want to make sure that I'm targeting a 70% chance of success. So with an Iron Condor, again, like we drew this up here, there are two sides to this trade. So if I want to have a 70% chance of success in here, then what I basically want is I want to have between the two sides equal 30% probability of in the money, because again, we're options short selling. So we want to take basically the 1 minus, or the inverse of that in the money number. So if you want to be totally neutral, you could be 15% on either side. And I apologize, I'm drawing with my mouse now, so you're going to get what you're going to get. But also, if you wanted to be slightly directionally bearish, you could say you wanted 20% over here and 10% over here. So you can kind of play with those numbers, but the goal is you wanted to add up to 70% to give yourself a pretty good risk to reward ratio. So let's go ahead and make a totally neutral trade here. So my options to get close to that number is 14%, 11%, and 17%. What I also want to look at, though, not just the percentage, I do want to see where people are moving, where the money is. So we got 10,000 open interest dropping down to 1,000 open interest there. But if I look at the volumes where the actual trades are going, these are really the two strike prices that look nice to me. So I want to make sure that I don't get, I want to make sure my trades fill, but I also want to make sure I get good pricing. So it's important to look at your volume before you actually place your trades. So to do this, I'm going to hold down my control button and I'll click on the bid at the 115 strike price. Now here's a little thing that I don't particularly care about for Options House, it blocks your view as soon as you click on one of them. So I'll click the 115 and then I'll go up to the 113 and I'll control click on the ask there. And that'll create one leg. That'll create the put leg of my Iron Condor. So now let's do the same process. We'll scroll down here and I'm looking down the probability in the money on the call side. So here I'm starting to see where I want to target. So at the 16% probability of success, I've got decent 2,000 open interest, but if I look at just the other side, I've got 11,000 and 15,000, and I've also got more volume on those sides. So I'm going to change a little bit which my anchored strike prices are because I want to make sure I get good pricing. So I'll take the 128 and the 130, and let's just see what this looks like. So once you've created your spreads the way you want to, again, you might change this over time and change this as you're analyzing it deeper. But I'm going to first click on create the order. And a couple things I go through mentally is, for one, I have mine set to automatically target the midpoint. We try to get very liquid stocks and ETFs that we're trading, but that bid-ask spread, because I'm very bad at math, let me go ahead and bring the calculator up here. So between 0.69 and 0.45, 24-cent bid-ask spread. So you multiply that by the 100 contracts, $24 to get in. If I took the bid, I could be losing essentially $24 there. And then again, I'm going to sell it at some point. So if I don't really pay attention to the bid-ask spread, I could be losing $50 per trade. Not really losing because, again, it's getting in. It's the cost of getting in. It's the slippage. But you don't want to lose that if you don't have to. So taking the midpoint does help reduce that while still giving you a good chance of getting filled. All right. So I've done this. Next thing I want to do is do position sizing. So as I'm starting out, I'm going to select 3% as being just a run-of-the-mill. I'm going to take 3% risk of my account balance. And what I love about Options House is it gives you a great quick calculator where you don't need to toggle up and toggle down to see where your risk is at. So if I go into that little calculator button, I can select the account value percentage, which is one that I'm going to choose. But you can also look at your buying power in dollar amounts, your buying power in terms of your total buying power there for day trading or margin buying power, and net account value. So you can select any one. I'm going to be simple right now and select 3% there. And it knows, okay, with 3%, I want 20 shares or 20 contracts to be traded here. So I'll hit save, and that'll lock in my position sizing. Now I'm going to analyze it. So I'll click on analyze. First thing I like to do, just to confirm to see how neutral I am, I'll click on the display and click here to show one standard deviation. So this shows that roughly 70% of the stock price is expected to move in that range. And again, remember, I was moving my strike prices maybe a little bit this way, maybe a little bit that way as I was selecting originally because I wanted to get good volume and have the best chances of getting filled. So now that I look at that, I'm still very neutral. I'm happy with those strike prices in terms of what it gives me. Now I'm going to look at the numbers. So my max profit is 1140, max loss is 2860. That I don't really care about the hard numbers. What I want to look at here is that is the 1 divided by the 2, and that gives me that 1 to 0.4 risk to reward ratio. Now, is that good? Is that not good? Well, it all depends on your probability of profit. And I know I'm blasting through this pretty quickly. I don't want to make this video too long, but if I look at 69%, we'll cover this more in depth, but what I look for is taking that 69 and adding it to the 40. And if it's equal to or greater than 100, by taking those numbers and adding them together, it's good pricing. It's fair pricing over time. It's better than a net, better than a zero-sum game. And we'll get more into the theory of why that is in a later video. But when I see this, I'm thinking money because this adds up to almost 110, and so that gives me some good opportunity. So let's go ahead and head back out of here. If you wanted to, you can check out the spectral analysis tab. What it does is it kind of shows that over the course of the options timing, where your dollar amount is as you go through. So for example, in December 30th, if the TLT's price is at 121 on that day, I would be expected to be making $716. So, and then as it gets closer to, you get closer to the maximum gain here at 1140, but it also shows you where you'd be anywhere along that continuum. So, and that's nice, but I kind of see enough of what I need as I look at this area here. So we'll go ahead and create this order, and everything still looks good. It's at a limit price at the midpoint. We'll hit the preview button and show again. So that's what we saw in the analyze section. The total, so $50 commission here is pretty hefty commission, but hey, this is a lot of contracts. And that's our total that we're going to receive. Shows you resulting buying power. Looks good. Let's go ahead and send that. All right, so at the expense of going a little bit long here, I'm also going to pop into the Thinkorswim platform and just see if I never looked at Options House, would I be making the same decisions? So I've got TLT pulled up in my Analyze tab of Thinkorswim, and I'm going to go into the the January contracts, and I'll do the same process. So I've got probability in the money pulled up here. I don't have, and I'm not going to do this on this video, I don't want to slow it down. I don't have the open interest and the volume on this tab, but let's go ahead and just move on anyways. So here, if I look at it, I would probably be taking the 112 strike price. Now let me bounce over and see what I actually took. So I'm going to go check out my orders. I took the 113, 115. I took the 113, 115. Okay, so this shows a higher amount, but let's go ahead and keep it the same. 115, 113, and oops. This is me being a newbie, so we're all learning together. Hold down your control button, and that'll create the spread. 115, 113, that creates a vertical, and I'll scroll down. And again, just to be apples to apples, 128 to 130. So 128. Oh, whoops. Bid ask. 128, 130. That should be. Let's see what happens. So I'm going to click into my risk profile section here. Oh, I messed something up, didn't I? Let's try this again. 115, 113. 115, 113. 128, 130. 128, 130. There's my Iron Condor. If you do click on the wrong orders, obviously you'll get the wrong result. So we'll click on risk profile and just take a look at this now as well. This looks obviously very similar to what we saw in Options House, but let's see. If I double click, I do like, I guess I'm just a lazy guy, but now if I look at this is a little bit interesting. So I pulled the exact same strike prices between the two platforms, but when I go into the risk profile, I would expect to see the same result. But here I see 62% chance versus the 70% chance that I saw, or 69% chance I saw in Options House. So either the calculations are wrong, maybe they're using a different model. I see down here this is using this guy's model. I'm not going to try to pronounce that name. But there's something going on. So definitely the calculations you're using are a little bit different. Now if I look at the credit, I've got 57 cent credit for this contract. So if I were to move forward, which I will because I want this to be an apples-to-apples comparison, once I do the confirm and send button, I'm going to see 57 max profit. Oh, I've only got the one contract. So how would I go about and increase the number of contracts? I hit edit. And now I'm back here. So this looks like you would need to, and there is probably a better way to do this. If I did 5, it'll move it all to 5. And so that's not too bad. But I don't really know what my buying power impact is going to be until I come here, and now I've got to do the math. 715, is that what I want? So I'm going to go ahead and just select the 20 contracts here. Ooh, and that's a big one. So if I confirm and send, I have, let me just double check here. I called over to TD Ameritrade, and I believe they made this change for me. So there's 4 legs in each contract. That's 20. So I've shifted around my commission structure. They have 2 commission structures. We'll talk about this in another video, but I get a flat $1.50 commission per contract with no trading fee, no ticket fee. So that brings my commission here on this one terribly high, $120, over double on the Options House. So definitely another feather in Options House's hat right now. But I'll go ahead and send this in, and we'll go from there. That's it for this one, guys.